If you had $100,000 right now, where should you put it? The obvious answer is simple. Buy real estate. That's what everyone says. Your parents say it, financial gurus say it, your uncle who owns 2 rental properties definitely says it. After all, people always need houses. Land is limited, property prices go up, case closed. Except, if that were true, why have some of the richest investors in history built most of their wealth through stocks? And why have thousands of ordinary people quietly become millionaires without ever owning a single rental property? Something doesn't add up, because the real question isn't whether real estate is better than stocks. The real question is, which one is better for you? And when this video ends, you'll be able to look at your income, your personality, your available time, and your financial goals, and immediately know which path gives you the highest probability of building wealth. Because one of these investments rewards effort, the other rewards patience, and choosing the wrong one can cost you years. You've probably seen this happen. A friend buys a rental property. A few months later, they're posting photos of renovations, talking about cash flow, showing appreciation numbers. Suddenly, it feels like everyone is getting rich through real estate. Meanwhile, your stock portfolio feels boring. You buy shares, you wait. Nothing exciting happens. At least, that's how it looks. But appearances are deceptive. In 2024, data from the Federal Reserve showed that roughly 66% of American households owned real estate through their primary residence, while millions also own stocks through retirement accounts and brokerage portfolios. What surprised researchers wasn't that both groups built wealth, it was how differently they experienced it. A property owner watches wealth happen. An index fund investor often doesn't. One sees tenants, the other sees numbers. One feels productive, the other feels inactive. Yet both may be growing richer. That's the first illusion. Visibility is not the same as performance. Real estate feels like wealth creation. Stocks often feel like waiting. Those are not the same thing. But the truly important difference isn't how wealth grows. It's how much of your life each investment demands in exchange, because one of them keeps calling you back. Literally, imagine your phone rings at 2:17 in the morning. You're asleep. Your tenant isn't. A pipe burst. Water is flooding the kitchen. The emergency plumber costs more than your entire month's cash flow. Suddenly, your investment has become a job. A very annoying job. Researchers from the University of California studying landlord stress and property management found that maintenance, vacancies, repairs, legal issues, and tenant turnover create ongoing management burdens that most first-time investors underestimate. The average rental property owner faces recurring maintenance costs equal to roughly 1 to 4% of property value annually, and that's before surprises. Roofs, water heaters, electrical failures. The kind of expenses that arrive without asking permission. Meanwhile, an investor holding shares of an S&P 500 index fund can literally sleep through the night. No tenants, no emergency repairs. Real estate can generate income, but income often arrives attached to responsibility. Stocks generate ownership, and ownership asks almost nothing from you. And here's something worth thinking about. How many hours did you spend last month maintaining your stock portfolio? Exactly. With this in mind, you'd expect stocks to massively outperform real estate. Less work, less stress, but history refuses to cooperate with that conclusion. In 2014, Nobel Prize-winning economist Robert Shiller published updated research comparing long-term returns from stocks and housing. The results surprised almost everyone. Stocks won, but not by the landslide people imagine. Over very long periods, U.S. stocks produced roughly 9 to 10% annual returns. Housing generally delivered around 4 to 6% before leverage. At first glance, stocks seem like the obvious winner. Then leverage enters the room and changes everything. Imagine you buy a $500,000 property using a $100,000 down payment. The property rises 10%. you've gained $50,000. On a $100,000 investment, that's a 50% return before costs. The stock investor needed a spectacular year to match that. This is why real estate creates so many success stories. Not because houses are magical, because leverage amplifies outcomes. Real estate's superpower isn't property, it's borrowed money. That amplification works beautifully until it doesn't. You've felt a smaller version of this before. Maybe with a credit card, maybe with a car loan. Debt makes good outcomes feel bigger. But what happens when the outcome isn't good? What happens when the market moves against you? Not in theory, in reality. In 2008, millions of homeowners discovered the answer simultaneously. Property values collapsed. Mortgage obligations didn't. Some owners lost homes. Some lost savings. Some lost both. Leverage behaves like a volume knob. When things go well, it makes success louder. When things go badly, it makes pain louder too. Meanwhile, many stock investors experienced losses. But diversified index investors didn't receive calls from banks demanding roof repairs or mortgage payments on vacant houses. Both investments suffered. One suffered with borrowed money attached. Leverage is neither friend nor enemy. It's an amplifier. And amplifiers don't care what song is playing. And that's the part everyone knows. The part almost nobody talks about is even more important. Because this leaves a strange question hanging in the air. If returns and risk are only part of the equation, what actually determines who becomes wealthy faster? Time is an investment. Most people only count money. Researchers from Vanguard and Morningstar have repeatedly found that investor behavior often matters more than investment selection. Translation: your personality can outperform your portfolio or destroy it. Some people love projects. They enjoy renovations, negotiations, finding deals, solving problems. For them, real estate creates opportunities to add value directly. Others hate all of that. They want to spend weekends with family, travel, build businesses, create things. For them, stocks create freedom. The hidden question isn't what earns more. It's what keeps you invested consistently for decades. The best investment is often the one you'll actually stick with. But look at this from the other side for a second. Maybe you're comparing the wrong things entirely. It sounds like we've reached the answer. Pick the one that fits your personality. Problem solved. Except the world's wealthiest investors rarely stop at one. Imagine you're building a castle, not a tent, a castle. One wall protects another. One tower supports another. The strongest structures aren't dependent on a single piece. The same pattern appears in wealth. Many high net worth individuals own businesses, real estate, stocks, cash reserves, different assets serving different purposes. Stocks provide liquidity. Real estate provides leverage and income. Businesses provide growth. Each solves a different problem. In fact, surveys from firms like Fidelity and UBS repeatedly show that wealthy households often hold significant allocations to both real estate and equities. Not because they couldn't choose, because they eventually realized they didn't need to. The debate isn't always stocks versus real estate. Sometimes it's stocks and real estate, just at different stages of life. I want you to keep one image in your mind. A toolbox, not a hammer, not a screwdriver, a toolbox. Because wealth rarely comes from one perfect tool. It comes from knowing when to use each one. Let's return to the question from the beginning. If you had $100,000 today, should you buy stocks or real estate? The answer isn't hidden in the market, it's hidden in you. If you value simplicity, liquidity, diversification, and freedom from management, stocks may be your best path. If you enjoy active involvement, can tolerate leverage, are willing to solve problems, and want to control an asset directly, real estate may fit better.